Let's talk about the future of investing and returning to core principles. To understand the future of investing, it helps to look back at its origins. In 1792, the original Buttonwood Agreement was signed, laying the foundations for what is now the New York Stock Exchange. This agreement was signed by 24 stockbrokers underneath a buttonwood tree in New York City in response to early financial turmoil in America. You see, after World War II, America was broke. They had to find ways to stimulate local economies so that they could build wealth. So this Buttonwood Agreement, it established rules for stock trading and setting commissions, creating a private community to fuel the local economy. At its inception, the New York Stock Exchange, from this document that was agreed upon, was grounded in three key principles. First, the community knew and trusted each other. They were all local and well connected. It's like that age-old time where you knew me, I knew you, I knew your parents, we knew each other's families. And we were in a time where we didn't have much of a choice but to trust each other in order to get out of the hole we were in. And so that first principle is important, to know and entrust each other in a local community. Second principle is that it operated on a revenue-only model. Investors made decisions using revenue reports from accountants. Back in that day, they had what were called runners who would literally run to the local accountant offices of these companies, grabbing their revenue reports, how much they were spending, how much they were making in profit. They'd bring that back to the group and they would analyze these revenue reports to determine if it was a healthy company, and it would help them determine if they wanted to invest in the company or not. This was really important and a big difference between today's markets where you are dealing with a ton of speculation. And we'll get into that. But thirdly, the third grounding principle that the New York Stock Exchange was grounded on was that it was based on a dollar backed by gold. This provided stability. And with these three pillars, the New York Stock Exchange powered economic growth by allowing local investors to trade commodities and securities backed by gold. Now, today, the stock market has drifted from these early principles. Today, you have private entities and government bodies manipulating markets through actions like Federal Reserve policies, and this breeds instability. This ecosystem, this new frontier of investing and trading is returning to those three original grounding principles of the New York Stock Exchange. And I'll explain how. Number one, they're offering a secure environment with a unified protocol that enables trust amongst peers. Whereas back in that day, you had local communities where everyone knew each other. It was a bit smaller. Today, it's a little bit more difficult to trust any and everyone on the internet. But fortunately for us, technology has caught us up to a place where we can have what's called trustless architecture, meaning we're depending on the technology and the mathematics instead of the person on the other side. So there's this technology that allows us to have trust and not have to trust in the individuals using it. So there's a unified protocol where you and I are forced to follow those rules, and that way we can trust each other. So secondly, companies in this new sort of ecosystem are again valued purely based on revenue and not speculative reports. This is important, and we're going to talk about this deeper again. But thirdly, what they have done is restored the stability in this new type of ecosystem as they did way back in 1792 when they were using dollars backed by gold. This new ecosystem is using what they're calling crowd units, which are digital dollars backed by silver. Crowd units create a safer marketplace. As economies decline, including America's, unfortunately, today, precious metals often increase in value, returning and retaining wealth across international borders. So crowd units themselves provide stability amid the volatility. And we're going to talk more about that, but I also want to explain two key developments happening both domestically here in the United States and globally that this new ecosystem is leveraging to help benefit their idea. First, new regulations are expanding private company fundraising, providing what was once only available and limited to Wall Street to individual investors like you and I on Main Street. You can learn more about this by studying the Jobs Act that was passed in a bipartisanship manner in 2012 under the Obama administration. Jobs Act is short for the Jumpstart Our Business Startups Act. And it's really important because 5 articles out of that Jobs Act were helping to essentially lessen some of the stringent regulations on private companies and giving them more ease of access to fundraise to individual investors like you and I. You see, this is really important. Over the years, the SEC and the governmental bodies involved take a lot of time to actually implement these articles within this Jobs Act. And that's why when it was passed in 2012, it wasn't an immediate effect. But fast forwarding years into 2023, where we are today, we're finally started seeing the effects of this. And if you put yourself in the position of a private company, you have only a couple of pathways to take. Number one, you go down the costly, highly regulated and stringent and timely path of going through an IPO, an initial public offering, so that you can become a public company and trade your shares on Wall Street. Well, not every company is suited for this, and also not every company has that major desire. It's very difficult to do. It takes a lot of time. It can be costly. And not only that, but it requires you as a private company to disclose a lot more about what you've got going on in your company than you may want to. And as an early stage tech startup, for example, you may have proprietary technology that you're not yet willing to tell the competition. Your other option is to remain private, but leverage venture capitalist firms. And all that can be helpful in some ways, but there are all drawbacks as well. You see, partnering with venture capitalists, especially in today's uncertain economic climate, you're having to get rid of a lot of percentage of your ownership in a lot of cases. Not only that, but because of the economic climate we're in, and naturally with venture capitalists, you also have these tight deadline turnarounds to essentially return massive returns on investment to these venture capitals. And it might not totally fit the timeline of your growth and scaling efforts. And so now, because of this Jobs Act, there's a third pathway for private companies. You don't absolutely have to go public on Wall Street. You don't have to depend on venture capitalists if you don't want to. You can solicit to individual investors, both accredited and non-accredited, like you and I, to issue and sell securities to essentially raise money for your company, for your growing and scaling efforts, without having to give up a massive portion of ownership of your company. And you can do it in a way that's beneficial for both you as a company and for you and I as the individual investors, because no longer, like these venture capitalists back in the day, do you now have to wait 7 to 10 years to see a return on your investment? This new legislation and the technology that combines with it allows us to make investments in early stage startups that allow us to see a return on our investment in as soon as 12 to 24 or even 36 months. And this is an incredible development. Now, the second key development I want to mention to you is that while public companies represent 33% of the global GDP, 66% of companies remain private. Now, Wall Street is for public companies, but what venue do we have for the private ones? This new ecosystem I'm talking to you about today is providing a new venue for these private firms. Now, I want to quickly interject a little bit of context about the world we're in today and talk about the leading reserve currency being at a crossroads. Those of you who have been paying attention know that the US dollar has been dominant in their global reserve currency since World War II. However, endless money printing and debt accumulation of the US dollar now jeopardize this status. Partnerships like BRICS, which is a conglomerate of countries like Brazil, Russia, India, China, South Africa, and many more now, are exploring alternative reserve currencies backed by hard assets, much like the dollar was back in 1792, but we've drawn away from that. They're now exploring using reserve currencies that are backed by hard assets like precious metals, like gold and silver. And currently, the dollar's utility as the currency for commodities and the oil markets is its value. But as the usage of the dollar declines, America's spiraling debt and infinite money printing of dollars is being exposed. We're seeing that in the markets, in the crashing of some of these banks, and so on and so on. This new ecosystem that we're discussing today offers a hedge to this sort of economic turmoil. They're rebooting the original revenue-only model, avoiding manipulation. And they're using digital dollars backed by silver to provide stability amid the economics uncertainty, which is sheltering us as investors and members as the seismic global shifts unfold. By returning to basics, they're creating a safe harbor for investing in commerce. And this new model insulates individuals from the debt-fueled volatility plaguing the current system, letting stability and transparency reign once more. Let's recap. The original grounding principles of the New York Stock Exchange that allowed it to grow and bring prosper to local communities was founded on three things. Number one, it was an environment that could be trusted. Well, lucky for us, nowadays, technology and entrepreneurialism has brought us to a place where we've developed one of the most securest platforms on the planet to allow us to trust. You see, the people who builded this platform, Sean Brim, for one, the CEO of this ecosystem, was at IBM Watson back in his heyday, helping the CIA build data warehouse models for counterterrorism efforts as a patriot for the United States. That's someone who knows what a secure system is. In addition to that, they're leveraging what most financial institutions of this world use, which is KYC and AML, know your customer, and anti-money laundering. They essentially just want to know that you are who you say you are and that you don't have a money laundering background so that we can prevent false identities and manipulation in this ecosystem. That's number one. Number two, they have returned to a revenue-only model, whereas today it's not based on pure revenue to determine if we should be investing in a market or a company. Today, you have the Federal Reserve, who is manipulating money supply, manipulating inflation rates, manipulating reports such as the CPI or the FOMC, which have massive market volatility and reactions. No, we're returning to the idea that, hey, we're making decisions based on your revenue, your financial health, and the potential growth of a company that you have. This brings more stability and more trust in the environment. And last but not least, we're returning and restoring digital dollars that have real value, not just the hope that this will continue to be used in the future by the global markets who tend to be and looking like they're choosing other assets, but real hard assets to back it. And in this case, they're using silver. And here's where it gets really interesting, folks. They, in addition to these three restorative grounding principles, are empowering individual investors further. As I've said, they've built a secure investing environment with rigorous background checks, but they're also helping individuals profit from their data. So this can help drive additional income to individuals who do not have the discretionary funds to use towards investing in the private markets. Let me let you in on a little secret, one that you probably already know. Companies today are currently using your information without compensating you. Today, companies track your browsing behaviors, your online purchases, your phone location, the stores you're entering, and for how long you're staying in those stores, and much, much more. And then what these companies do is they aggregate this data and combine it with other profiles that have similar socioeconomic classes and geographic locations as you. And then they sell it in a package to buyers who then advertise to you. We all know that we're seeing advertisements pop up on our phones and our laptops, things that are only relevant to our conversations that we were having just yesterday or the day before, or were only relevant to the store we walked in the week before. That's no coincidence. Hedge funds themselves are leveraging this type of technology and business model to do exactly that and make money off of your data. And the troubling aspect is that you're not being paid for it. So, what's the big idea with this new ecosystem we're discussing today? They've built a platform that places your human identity as the North Star. In this system, you control your data repository and you get paid when it's accessed. Think of yourself like a stock or a commodity. If you choose to share your personal data with companies or industries that you like and or do business with, then you get paid in silver, crowd units. And with your earned crowd units, you can hold them as the value of these crowd units rise, or you can turn into the ecosystem, into their digital storefronts and purchase products and services from the ecosystem. Or you can invest this new passive income you've earned from contributing your data into the private markets, into these private companies that you want to see win and grow. Let me put this concept into an example. Consider one of the new partners that are joining this ecosystem. And I won't get into the high profile clients that they've already onboarded, like banks or, energy departments or so on. I'll let them announce that as they get closer to those press releases. But I'll give you an example of an interesting company called Quattro Brush. Quattro Brush is a company that has gained FDA approval for the first toothbrush in the world proven to regrow your gums. How they do this? Well, it's in the name, Quattro Brush. They have an electronic toothbrush that has 4 heads on it. And these 4 heads sort of wrap around the entirety of your teeth and gum line, allowing for the regrowth of your gum, giving you within just 30 seconds a more optimal brush than you would with a regular toothbrush in 5 minutes. Now, here's where this concept gets put into a easy to understand example. Say this is a company that you like and you want to invest in. Well, you've contributed some of your data in the ecosystem. So you've, in a passive manner, earned crowd units. And you can use these crowd units to invest in the company. Well, that's great. Now, you also want to buy their toothbrush because you like the company, you're invested in them, and you want to continue to support them. So you go on their digital storefront in the same platform, same ecosystem, and you go to their digital storefront and you purchase a toothbrush. Great. Now you're excited about the fact that you've invested in this company, you've purchased one of their toothbrushes, so you refer one of your friends to purchase a toothbrush or to invest in their company. All of these ways in which you are investing in this company and you're earning crowd units for referring others. As an investor, you have now become a market maker because, again, we've restored a revenue-only model in this ecosystem. So when you purchase a toothbrush, as an investor in this company, you're actually increasing the revenue of the company, which in turn increases the value and the stock price of the company, which in turn benefits you as an investor, making you a market maker in a secure, private environment. This is the path forward. This future is possible because of the team of all-star cast that have built this, with backgrounds spanning mergers and acquisitions on Wall Street, quant modeling, data science, and more. They're possessing the expertise and the drive to disrupt investing, and they're returning it to its roots in a stable, transparent, and empowering environment. The time has come to rewrite the rules. Their ecosystem leverages revolutionary models to put the power back where it belongs, with you and I and each and every individual. The opportunity for prosperity has never been greater. The future of investing is here. And I mentioned a little bit about their team and the type of expertise that's coming from. I'll say again, Sean Brim, the CEO of CrowdPoint, was building data warehouse models at IBM Watson for the CIA, aiding counterterrorism efforts. This was in addition to his former military officer days. This is in addition to his successful build and exits of other similar startup companies before moving on to his third company with CrowdPoint. Nadab Akhtar, the president of CrowdPoint Technologies, has moved over $8 billion in mergers and acquisitions on Wall Street. Dr. Wolf Kohn, that's Wolf, Kohn, you can research his name. He's an AI luminary in the industry. He's worked for almost every major institution when it comes to data science and AI. He delivered quant models previously, helping Citigroup, one of the biggest banks in the world, profit of over $4 billion with their quant models. He's bringing those and more optimized models into this ecosystem as a member of this team. In addition to that, you have Daniel Guinan, a CTO for CrowdPoint, who has and is responsible for bringing online banking transactions and services as one of the first in the world with Wells Fargo. He did much more in between, but eventually worked for a company called Sun Microsystems. If you do your research, was eventually acquired by one of the most profitable companies in the world, Oracle. Why? Partly because they built Java. Java is one of the most widely used programming languages and frameworks in the world today. Specifically, Daniel Guinan led a team that introduced Java Card, part of the Java framework, which quickly became, if you remove smartphones and desktops from the picture, one of the most ubiquitous computing devices on Earth. And he had a lot of experience with their Java Commerce shop, which eventually built something called Java Coin, although never introduced to the public, actually had a very similar framework as Bitcoin 10 years before Bitcoin was ever introduced. So he certainly has experience with things like cryptocurrency and cryptography. And more members and partnerships are to be announced moving forward. Now, to recover what we've talked about with crowd units, I want to be very specific. We're not talking about cryptocurrency here. You see, cryptocurrency has been affiliated with offshore, unregulated scams and Ponzi schemes. Crowd units are an SEC-filed security with a fixed supply that is backed by silver. Wow. Traditional cryptocurrency certainly falls short in many of these areas, but I want to be very specific. First, cryptocurrency typically does not even have a business model tied to it. Secondly, there's nothing backing the asset to give it stability or value. And thirdly, they're typically tied to some offshore company that's unregulated. Crowd units offer rebuttals to these three challenges. First, crowd units are required to purchase in order to pay for the cloud services, the data storage, the language model services that CrowdPoint offers via their technology platform, which is what underpins this entire new sort of investing market of their ecosystem. You see financing, trading, markets that we've discussed on this call are just one component of the overall ecosystem. You also have the identity component, helping you to protect, own, and monetize your data. You also have the storefront component, which we've talked about in their decentralized marketplaces. You also have traditional capital component, which is offering specialized banking services. Yes, CrowdPoint has purchased a bank, and they can't do that without being regulated and adhering to FDIC-approved banking regulations. Now, Moving forward, this is a business model that is well documented and successful in history. By the way, Amazon, Google, IBM, and many other cloud platform providers have been successful at this model for a long time. What they do is they offer cloud services, analytics services, and they tally up all the credits that a company owes at the end of the month. And a company must pay for those credits in dollars or whatever their local fiat currency is. The difference here in this ecosystem is that those companies are required to purchase crowd units. And crowd units have a fixed supply. So every time they purchase these crowd units to pay for the cloud services they're using, well, it reduces the overall supply of the crowd unit supply. If you take into effect the simple law of supply and demand, this adds a level of scarcity, which, as you know, the more that get used, the lower the supply, increasing the value of the crowd units that you're earning from your data contribution. Additionally, this is significant because now, as an SEC filed security with a fixed supply, they've also backed the crowd unit with silver, a precious metal that brings stability to the asset. It gives investors confidence and a strong floor. By the way, silver has never gone to zero. It's been used since the time of the Greeks, and it doesn't have just inherent value across international borders, but it has industrial use as well. I mean, it's used in solar batteries, it's used in medicine, and more. And so this floor that the value of the crowd unit can never go below also has an accretive value and a potential to appreciate too, because as economies decline in history, it shows us that precious metals and their values increase. So this is a registered security filed with the SEC, tied to a US-based company with no fraud, no scams, with a SEC filed security with a fixed supply backed by silver. And this is the core components of what I wanted to talk to you about today. If you've listened this far and you're wondering what's the call to action, well, today you can purchase crowd units at 1 penny each. And this you can do until September 27th of 2023. After that, the ending of regulation crowdfunding round, an SEC regulated process, will end. And soon after, Regulation A will launch at a new and higher price. This is important because if you think about, without speculating, the idea of crowd units, each crowd unit is backed by roughly 1 gram of silver. You can do the math, you can do the research to see that 1 gram of silver today is trading for a price of roughly 75 cents per gram. And if you're able to buy crowd units at only 1 penny per unit, which is also backed by 1 gram of silver, and you consider all the additional utility we've just described, then it should be a compelling area of interest for you. Secondly, if you're interested, but you're still not sure how this all works for you, I invite you to come and join us on weekly calls every Thursday at 5:30 p.m. Central to learn more about this ecosystem and the future of investing. If you're looking for the Zoom call details, you can simply reach out to me. My name is Hunter Carithers, otherwise known as Digital Oil Hunter online, both Instagram and TikTok. Or you can find us at Telegram and Discord in the Crowd Point rooms to discuss with hundreds of other individuals who are on board, and we'd love to get you caught up and answer your questions. So please reach out to us to get those details so you can join the call and simply, no obligations, no names, no numbers, no emails, no obligations, just listen and learn more. Hope to see you there. Thank you for your time.